Okay, so we're just going to give it a couple of minutes to let people join.
Sure.
Thanks for joining us. We're just giving it a minute or two just to let others join us. I know it can take a little while to connect, so just bear with us for a minute or two. Hi everyone, and welcome to this live talk on the cost of a financial crisis. There will be a presentation by Dr. Pedro Matos Serodio. I hope I pronounced that right, Pedro.
You did, that's great.
Great. During the presentation, if you do have any questions, please feel free to ask them in the Q&A button just at the bottom of your screen, and I will read them out at the end. If there are any that are non-subject specific that I can answer, I will do so during the presentation. But for now, I will pass you over to Pedro.
Well, hello everyone. Very happy to have you all here today. So the idea behind this session is for us to go through some of the key concepts that you might experience if you choose to do economics and you choose to do monetary policy. So I wanted to give you a flavor of the kinds of things that we would be doing in one of those lectures and what we would be talking about. And in particular, with respect to the financial crisis, there were significant changes in the way that central banks operated following the financial crisis, quite apart from all of the turmoil that generated, all the human costs in terms of unemployment and the loss of income. There were also significant consequences for how policymakers had to change their policy tools in order to be able to restore the economy back to full employment and to functioning healthily. So I am going to try and give you a flavor of what we would be talking about. So some of the more technical things that we'd be talking about, I promise I'll try not to be too dull and boring with it. But the idea is for us to, at the end of this, have some idea of what challenges the crisis posed in terms of changing how policymakers had to operate. Okay. And we will, at the end of this, I would also like for you to have some sense for how the central bank sets policy. So what policy tools they use and how they've had to adapt to the financial crisis. So just as a brief introduction to what we're going to do. So we're going to go over how central banks set the stance of monetary policy in practice. So what do central banks actually do to set monetary policy? What are the tools that they typically use? We will think about specifically what the Bank of England does, because that's what we're most concerned with being in the UK. But many of the things that we're going to be talking about are things that are common to other central banks. So we will focus on the Bank of England, but if you are from another country or you're interested in another country, the things that we are talking about here will apply to almost every other central bank of an OECD country. Not exactly the case of the United States. The United States is a little bit different for a variety of reasons, but most central banks operate in a very similar way. And if you, at the end of this lecture or this short presentation, take something out of this. So if you keep something in your minds, you'll already know a lot more about central banking than the vast majority of people. So hopefully this will be useful for you, not just to pique your interest in terms of what this is about, but also giving you some insight into how things work. A lot of what we're going to be discussing is available in materials provided by the Bank of England, but of course, these are very long books and they go through a lot of detail and a lot of things that maybe you don't necessarily need. So I'm going to try and distill that and summarize it in a way that's going to be at least a little bit more interesting for you. And we're going to think about essentially the framework that the Bank of England follows to try and achieve its monetary policy objectives. So as a brief summary of what we're going to be talking about, there are three basic things that we're going to be covering. The first of these is how interest rates are set in normal times. So we will establish that the primary tool, the primary policy objective of central banks is the interest rate. So that's what central banks always try and affect to have an impact on the economy. And you might ask yourselves, well, why are interest rates so important? Because remember, interest rates are an extremely important element in all of your long-term consumption and investment decisions. If you want to buy a house, the interest rate that you will be charged will be extremely important. If you want to release a car, the interest rate that you will be charged will be extremely important. If you use a credit card, the interest rate on your credit card will be extremely important. So your consumption across a different type of good or asset is heavily influenced by how much you have to repay the bank. If the interest rate's really high, you maybe don't want to spend so much, but if the interest rate is really low, as it currently is, that incentivizes people to want to spend more and do more with their with the borrowing that they can now achieve. So that's one of the elements. The other one is, obviously, if you're a business owner or if you're thinking about investing in something, then the rate that you would have to pay to borrow, or the opportunity cost of your funds, so the amount of money that you could earn just by parking your money in the bank, well, all of those are also affected by the interest rate. The higher the interest rates, the more difficult it is going to be for you to repay the loan that you've asked for the investment. And so it's going to mean that unless it's a really good investment, maybe it's not worth it. So again, higher interest rates make economic agents, people and households, decide to spend and invest more when these rates are low. So interest rates are extremely important as they're a very important tool for how the central banks can affect the rate of economic activity throughout the country. So we're going to think about how interest rates are set normally. So how does that work? And we will move on to the challenges that the financial crisis of 2007 and 8 posed to central banking. Now, as I said before, the costs of the crisis are, of course, not just covered in how it affected the way that policy works. It had, of course, a very significant impact on the well-being of millions of people in this country. But remember that the way that central banks and other policymakers can help make people's lives better is if they have tools with which to do that. So if they don't have tools to do that, to try and improve economic conditions, well, then there's very little that they can do. So the challenge that this posed to central banks around the world, and in particular the UK, is an important component of the legacy of the crisis. So after that, after we see what challenges were posed by the crisis, we will also think a little bit about how monetary policy is set today. So essentially, the idea for what we want to talk about is there was a way that monetary policy was conducted. The central bank would set the interest rate using a particular mechanism. And following the crisis, it can no longer rely on that mechanism. So it had to do something a little bit different. What we want to think about is, well, what was that change? And do we know how the central bank operates right now? So what was the process that the central bank followed before the crisis? That was called reserves averaging. So in order to talk about reserves averaging, we need to understand what central banks do. Just like people have deposits at commercial banks, all of us would have a deposit at a commercial bank where we put our savings or whatever money we have to spend, and the bank keeps those electronic deposits, that electronic money, for us to then spend progressively throughout the month or throughout whatever period we hold that money there. So it's basically a way to keep our money safe electronically so that we can then spend it whenever we want. And just like we have deposits at commercial banks, Those banks, so if you think of Barclays, HSBC, Santander, all of these banks will have deposits at the Bank of England. So they have their own deposits at the Bank of England, and the banks can use these to make payments to each other, to settle debts, etc. So just like we use deposits to pay, to make transfers and to pay for purchases to others, the banks can do the same with these deposits at the Bank of England. We call those deposits central bank reserves. So the big difference between the deposits that we have at the banks and that the commercial banks have at the central bank is that our deposits can be created by the commercial banks, but the central bank reserves, or the reserves that the commercial banks have there, can only be created by the Bank of England. So to make this a little bit clearer, the Bank of England is the only institution in the country that can literally create money out of thin air. Okay, they can just create money by pressing a button, and automatically there's more electronic money in circulation. When they do this, we call that central bank reserves. Okay, if at any point you have any questions, please just interrupt me and send them through in the chat, and I'll try to get back to you whenever possible. So what do the banks do with these reserves? Well, they can borrow or lend these. So if a bank has a lot of reserves, maybe it doesn't need them as much, so it can lend them to other banks that need them. And as they're borrowing and lending to each other, they will be borrowing and lending at a particular interest rate. And that is the interbank interest rate, or the market interest rate. Now you might think, well, why do I care about all of this? Why do I care what the interest rate is that Barclays lends to HSBC? Well, you care about this because every time that you try and go buy a house, or that you get a credit card, or that you take any loan of any kind, all of these, so for example, to go study, that's an extremely important component of expenditure that you might potentially embark on. The interest rate that you're charged depends on this interest rate that the banks charge each other. So if your bank that you're borrowing from has to pay a very high interest rate, then you have to pay a very high interest rate because the bank is going to want to make a profit. So we want to understand how it is that these interbank interest rates function. So how does this interest rate that the banks lend to each other functions? Now, this interest rate is determined by the banks. They will lend and borrow and negotiate the interest rate amongst themselves. And so the central bank, the Bank of England, cannot really determine this. It can't determine this because this is something that the banks decide among themselves. What the central bank can do is determine the bank rate. So whenever you hear about the Bank of England lowering interest rates or increasing interest rates, what you're really hearing about is the central bank, or the Bank of England, setting the bank rate. It's the official policy rate. And so what is this policy rate? What is this all about? So let's think about how the central bank might operate with these commercial banks, with Barclays and HSBC and Santander, et cetera. These banks will want to hold on to more deposits at the central bank, or reserves, the cheaper the interest rate is, because that means that it's really cheap to borrow reserves, right? Just like from your point of view, if the interest rate is really high and you have some money in the bank, you start thinking, maybe I should put this money in a savings account somewhere. Because if you don't put your money in a savings account, you're losing all of the potential income that could generate, right? You're missing out on the interest. So when the interest rates are really high, you maybe don't want to keep a lot of money in the bank, because otherwise you're losing this money. It's the same with banks. So banks, if the interest rate is really high, they really don't want to have a lot of reserves, because it's really expensive to hold on to these reserves. They could be lending them to somebody else. When the interest rate is really low, then the banks will borrow more, and they want to have more reserves in their pockets at the central bank, their deposits at the central bank, because it's going to be cheaper. So what that means is that we're going to end up with a negative relationship, so a demand curve, where the higher the interest rate, the fewer reserves you want. The lower the interest rate, the more reserves you want. So it's going to be a negative relationship here. So what does the central bank actually do? Well, the central bank, the Bank of England in the case of the UK, will provide these reserves to the banks. And in providing these reserves to the banks, they can affect the market interest rate that banks lend to each other at. So imagine that you're Barclays. You think, well, I need to get some reserves because I want to process more payments. People are using the Barclays online app more, they're making many more transfers, they're paying each other more, so I need more reserves. There are two ways that I can get the reserves. Either I can borrow them from HSBC, or I can borrow them from the central bank. If the interest rate on these two is very different, then you will always go for the one that's cheapest, which is typically the central bank. So from that point of view, the two interest rates are going to be very closely connected. That's how the central bank can affect the rate that you face as a final consumer. So if we look at this representation here, so this is from the Bank of England. I know it looks a little bit complicated, but by the end, I hope we'll understand this a little bit better. They can simply increase or decrease the amount of reserves that they offer to banks to reduce or increase interest rates. So if they want to lower interest rates, they will simply put more money out there. They will print money. There's more supply of these reserves, and that is going to lower the interest rate. What's the idea here? The idea is that if you put a lot of money into the economy, then all of these banks will have enough central bank reserves that they don't really want to pay too much to borrow it. And so by flooding the market with reserves, you lower the interest rate. If you want to increase the interest rate, well, you make these reserves really rare. So if there aren't enough of them to go around, the banks want to pay extra to get access to them. Okay? So in many ways, what we need in order for the central bank to be able to set interest rates is we need money to be a rare thing. You can't have too much money flying around, because if you do, then the banks wouldn't be willing to pay anything to get more of it, right? So if you're a bank and you feel like, I have enough reserves, I have enough cash to settle transactions every day, if that's the case, then I don't really want to pay any extra to get more reserves because I have enough, I have what I want. So what the central bank does normally is it keeps only a small amount of reserves in the system so that the banks are willing to pay something to get them. So in normal times, there are not going to be enough reserves for everyone to have as much as they like. So every single banking institution would always like to have a little bit more in reserves, but because there aren't enough to go around, they become expensive. And so they will hold back on that and not have as much as they want. Now, with quantitative easing, I don't know if many of you are aware of what quantitative easing was, but it was a policy that was introduced around the time of the financial crisis. And that was because the central bank simply reduced interest rates by increasing reserves in circulation, and they reduced the interest rates almost all the way down to zero. And this created a problem, because if you keep increasing reserves after a certain point, the banks don't want them anymore because they have enough. You've already given as many reserves, as much money to the banks for them to operate as much as they would like. And so if you've done that, then they don't really want anymore. Remember that the banks, you don't just give the reserve to them, you have to exchange them for something. And the banks will say, well, I don't want any more of the reserves because I have to give up other assets to hold on to these reserves. So unless you pay me to hold reserves instead, I don't want to hold them anymore. And so this created a problem for the central bank, because once we get to this point, you increase the amount of reserves in the system to the point where there are just too many in circulation. The banks have enough liquid assets, and so they don't need any more. So it's a little bit like, imagine that somebody gives you a certain amount of money for an asset that you own, like your house, right? So now you have a lot of cash. You don't really need to sell any more assets to get cash because you already have a lot of cash to spend. You're not going to spend all of it. So if you're not going to spend all of it, then you have no need to sell more things to get additional cash. And that's what happened with quantitative easing. The Bank of England simply increased a lot of the amount of money in circulation by buying things from the banks. Remember, the money isn't given away. The central bank creates it, but uses it to buy things from the banks. And the banks thought, okay, so we now have enough liquid assets. We don't really need to have any more of these. So we're not willing to hold on to these reserves unless you pay us something. And what happened was that in the previous diagram, as you can see, we're operating at a point where there aren't many reserves in the system. So the banks are willing to pay some amount for it. But once you increase the amount of reserves in circulation, the banks are no longer terribly interested in holding on to these. So effectively, what you have to do is to start paying them a certain amount to hold the money in the bank. It's a little bit like, imagine that you have a certain amount of money in your bank account, in your commercial bank account. If you're worried that you have too much money there and you need to make savings in an asset that earns some interest, say you want to invest in the stock market, etc., if the bank wants you to keep your money in the form of a deposit, then the bank needs to start paying you higher interest rates. Otherwise, you'll take your money out and invest it somewhere else, because you don't want to have so much money that's not being used productively, okay? And this is a very similar process here. The commercial banks don't want to have all of this cash at the central bank because this cash is not really doing anything. They could be using it to lend to households. They could be using it to lend to you to buy houses, to create businesses, etc. So if the banks are in a situation where they have enough of this money, they think, I don't need any more of it. So the only way that the central bank can convince them to keep their deposits at the central bank is by paying them a certain amount of interest rate. And so what this means is that the central bank doesn't need to intervene by setting the quantity of money in circulation anymore. They can set the interest rate simply by telling the banks how much their deposits are worth. So whereas before, the central bank would change the supply of reserves, they would reduce it to increase the interest rate, or increase reserves to reduce the interest rate. Now they set the interest rate directly through the rate that they pay the banks to hold in deposits, and they don't need to do anything else. So in many ways, the financial crisis created a problem for the central bank because now they had to reduce the interest rates and expand the amount of money in circulation. And that led to interest rates falling very significantly. And the central bank didn't want to see that happen. They didn't want interest rates to become negative. So just as an aside, in many countries around Europe, Switzerland, Sweden, Denmark, at various points around 2014, 15, interest rates were negative. There were examples of somebody taking out a loan to start a hairdressing salon, for example, and the interest rate on that loan was negative, which meant that the bank had so much cash that they wanted to get rid of that they were paying somebody to take out a loan to start a business, right? So that tells you something about what the effect of interest rates is. And the central bank was worried about the consequences of making interest rates too negative. This is something that we talk about in the module a lot. So if this is sounding confusing or interesting to you, this is something that we discuss in great detail. We also talk a lot about what quantitative easing is. I'm not going to get into that in this talk because it's already quite dense. But effectively, when the central bank or the Bank of England increased all this amount of money in circulation, the banks didn't want to hold so much of it. So the only way that you can make the banks hold on to their deposits at the central bank is by paying them something for those deposits. Just like when you deposit a certain amount of the bank, if the bank wants you to keep that money there so that they can use it, then they need to start paying you a little bit more, because otherwise you're going to take it out and you're going to do something more useful with it. You're going to invest in something else. So what this means is that the Bank of England now doesn't need, just like any other central bank in Europe that uses the same mechanism, they don't need to intervene all the time. So all they need to do is to set the interest rate that they pay to these banks and the deposits that they hold at the central bank, and that automatically sets the interest rate that us as consumers that we will face if we try to get some loans, etc. So in practice, what this meant is that we introduced what is called a corridor system in the UK. So this corridor system works in the following way. So your policy rate, the interest rate that you want to set, which has the I asterisk here, is where the demand curve meets the supply curve. So the demand curve is downward sloping. The more expensive something is, the less you want of it. The cheaper it is, the more you want of it. So there's going to be a downward sloping demand curve, and there's going to be a fixed supply that the central bank determines. If the central bank wants to make interest rates lower to make reserves cheaper, well, then they will just increase the supply. And as they increase the supply, the interest rate will fall. If they want to make the interest rate more expensive, then they reduce the supply and the interest rate increases. Now, the problem is that if the demand is changing a lot, so some days the banks want a lot of cash, the other days the banks don't want a lot of cash, it's changing all the time because our consumption habits change all the time, then what this is going to do is that the interest rate could be very volatile. It could be changing all the time. And the central bank doesn't want to do that. The central bank wants interest rates to be stable and predictable so that, when you're going out to get a loan for a house, you don't want to be quoted one interest rate in the morning and then you see another bank and the interest rate is completely different in the afternoon because it's changed already. So what the central bank does is introduces a lending rate and this rate that we've been talking about, which is the deposit rate on the reserves. So let's imagine that you're a commercial bank. This is the market interest rate, and this is the rate that you can get if you keep your reserves at the central bank. You don't do anything with them, you just park them there. If you do that, you earn at least this much. Let's imagine now that you have one bank that offers to pay you an interest rate that is below this. So they say, let me borrow some money from you and I will pay an amount that is below this deposit rate. Clearly, you wouldn't accept this because you can just put your money at the central bank and earn at least this amount. It's a little bit like saying you can put your money in the bank and the bank pays you, say, 1%, and then somebody offers to borrow from you at 0.5%. You'll say, well, why should I agree to this? This is a terrible deal. I can get at least 1% if I leave it in the bank. So if you're not going to pay me at least that, I don't want to lend to you. So the banks will think very similarly. And what this rate is going to do is basically ensure that no bank is going to want to lend below this amount. Similarly, the central bank will offer to lend to the banks when they need to borrow at a lending rate that is a little bit above the market interest rate. So imagine that you're a bank that's in a little bit of trouble. You're in need of a certain amount of liquidity. You need to borrow money because you need to make some transactions and settle some debts. And the market quotes you, say, an interest rate of 2%. So 2% that is much higher than 1.5%. So the problem is that, of course, you can get the central bank to lend to you at 1.5. If the market only wants to lend to you at 2%, then you don't go to the market. You go to the central bank and you borrow directly from the central bank. So this interest rate is going to make sure that no bank borrows above a certain amount. So this rate makes sure that no bank lends below this amount. And this rate makes sure that no bank is going to borrow above this amount. So effectively, the interest rate has to stay inside of this corridor. So this is why we call it a corridor system, because you put a ceiling, you put a floor, and everything happens inside of there. So what happened after the crisis or during the crisis is that as the central banks implemented quantitative easing, the amount of reserves in the system increased by so much that they had to rely on this lower bound of the system, this floor, to keep the interest rates under control. So they don't have to intervene anymore to try and guess where the demand for reserves is going to be. In practice, what has that meant over time? So if we see the interest rate has always been very, very volatile, it became slightly less around this period. But as we can see, following the crisis and the implementation of QE, it's been extremely stable. And so it's always been more or less around the value that the central bank wants it to be. So this system has been extremely effective at keeping interest rates under control. And nowadays, the central bank doesn't need to increase or decrease the amount of reserves in the system in order to set interest rates. So they can just decide how much they want to pay the banks in interest, and the market will do the rest. And the banks will lend to each other at close to that interest rate. So let me leave you with one particular question, which I think is going to be interesting for those of you who are interested in these matters. Before, with the previous system, what the central bank had to do in order to increase interest rates was to reduce the amount of money in circulation. So if you want to make interest rates go up, you reduce the amount of money that is in circulation, and banks will increase the interest rate because there's less money, right? Money is now expensive. There's not very much of it. So money is expensive. Banks need to pay more to get reserves. They will charge you more to borrow. If there's a lot of money in the system, however, how can central banks in the future increase interest rates? Is this possible, do we think? How can they possibly increase interest rates if they can't really reduce the amount of reserves in the system because there are so many? You would cause all kinds of problems. So that's the question that I leave you with. Thank you very much for your attention. I know this is a very challenging technical topic, but for those of you who are interested in policy, knowing how central banks actually set policy and the challenges that they face in setting policies is extremely important, because we want to know exactly how we can improve the state of the economy. And without understanding how these things work, there's absolutely no hope for us to be able to use policies to improve people's lives. Okay. All right. Any questions that anybody has?
Thank you so much. We do have one question. Shanette has asked, when a bank just prints money, doesn't that cause inflation?
So in general, that would be the case. In normal times, if the central bank is just increasing the amount of money in circulation, what that does is it should lead to very low interest rates. When there are very low interest rates, we all think, well, let me buy a house, or let me buy a second house for those people who are in a position where they can buy a second house, or let me get a new car, or let me do any of these things. So very low interest rates, the idea of very low interest rates is that you want to incentivize people to spend. If people are being incentivized to spend a lot because it's really cheap to borrow, that will lead to maybe too much spending and eventually in the inflation in the future. So you lower interest rates to get people to spend. As people spend more, the economy recovers. And when the economy starts recovering and you start worrying about inflation, then you start wanting to increase interest rates again. So let me ask you a question, which is what we ended up on, which is, if there's all this money in circulation, should we worry about inflation being a problem? Is the central bank going to lose control of inflation? What do we think?
You can pop your answers in the Q&A box, so we'll just give you a minute if anyone wants to chime in on that. Or you can raise your hand and we will unmute you if you prefer.
It's okay, there are no right or wrong answers. So let me just try to make this a little bit more relatable to you. There are many influential, famous economists who don't understand or who don't know how to answer this correctly. So if you're unclear as to how you should be answering, don't worry, because a lot of people are worrying about something that they don't really should be worrying about.
So we've had a reply. Probably not, as quantitative easing will only be used in a recession in the first place. Hang on, so we'll say that was answered. And then we've got another question. What is the role of the central bank in the current crisis? What actions should it take?
Right, so let me answer the first reply first. So that's a very good point. The central bank will only use QE in a recession. That is true. Now, what some people worry is that QE becomes a permanent thing, that the level of money in circulation is going to be higher forever. And what we just talked about is an answer to that. It is to say, it doesn't really matter that there's all this money in circulation, because the central bank can just increase the interest rate on the deposits and automatically all the interest rates have to go up. Think about it this way. If the banks are currently offering interest rates at 1% and the central bank increases the interest rate on the deposits to 3%, do you think any bank will lend to you at 1% if they can just put the money at the central bank and earn 3%? Probably not, right? Because what this does is it gives banks an alternative at a much better interest rate. And so it automatically makes borrowing more expensive for everybody. And you've kept the amount of money in circulation the same. So you don't need to touch that anymore. So this worry that people have that too much money can lead to inflation, this new way the central bank is setting policy means that we don't have to worry about that anymore. We can just pay the banks to keep the money safe at the central bank rather than lending it to people. So that means that people aren't buying more things, they're not spending more, and therefore they're not contributing to inflation. Okay. Now, so what is the role of the central bank in the current crisis? What actions should it take? So there are several different things that the central bank has done and can do. The first of which was to lower interest rates. That is usually the first one that a central bank will turn to. Now, interest rates were already quite low, so there's not very much that you can do once the interest rate is already very close to zero. So other things the central bank can do is engage in programs like quantitative easing. And what programs like quantitative easing do is they lower the interest rates on many different types of assets. So for example, if they buy long-term government debt, say like 50 years, that's going to make the cost for the government to borrow extremely low at a 50-year period. So imagine if the government wants to engage in a public spending program, if they wanted to, say, build more roads or build bridges or build more infrastructure, they could now borrow really cheaply over 50 years. And so that means that you can do a lot more because the financing for that is going to be really cheap. It's going to make the financing for companies really cheap, so they can engage in this long-term investment, these long-term investments, and they're not going to pay very much. So at what rate should interest rate be? That is an incredibly good and extremely difficult question. We talk a little bit about this because some people say that we should make interest rates as negative as they should be to get people to spend, right? Imagine what you would do if instead of borrowing at, say, I don't know, 4 or 5% for a student loan, you're actually being paid 4% a year to take out a student loan. Clearly, this would be a huge incentive to take out a loan. Now, the problem is we have something called cash, physical currency. And the problem with physical currency is that it always pays an interest rate of 0. So an interest rate of 0 is always much better than a negative interest rate. If a bank has an alternative between having a lot of cash or lending to you at negative 4%, they will choose a lot of cash. And the worry here is that if interest rates become too negative, then the banks will not want to lend at all. So they will just, everybody wants to hoard cash and nobody spends anything. And that could be really, really problematic. It could bring down the financial system. So a lot of people say you should lower the interest rate all the way to 0 and then do other things while keeping the interest rate close to 0. So doing things like quantitative easing to lower long-term interest rates, to make the borrowing by financial companies lower, lowering mortgage rates, which usually are a little bit higher than the policy rate, et cetera. So the central bank kind of reaches a problem where they can't go too far below 0. So what changes to the ECB would I like to see, if any? Well, that's a great question. So some of the things that the ECB needed to change have already been changed in the aftermath of the financial crisis and the Eurozone crisis. There was a problem where the central bank, if it wants to do QE, if it wants to buy government debt, it has to buy government debt of all of the different countries in the EU. Now, the problem is if some of this debt is potentially going to be defaulted on at some point, the ECB is making itself go bankrupt. And if the ECB is ever at a point that it might go bankrupt, it can still operate, but the countries that are part of the ECB, that are part of the European Union, would probably end the euro altogether if that were to happen. So in order to make sure that the central bank can continue to operate, it needs to be making purchases of government debt that we know are sustainable. And so this required having a new institution set up where the central bank can only buy the government debt of a country if the government debt of that country is going to be sustainable in the long run. And if it's not, the country joins a program to bring it back to becoming sustainable. So there are a lot of proposals of the central bank, say, buying debt that is issued by the entire European Union, things like that. I'm not too crazy about that idea. I do think the ECB should become more aggressive in terms of not worrying so much about inflation. In the past, it has worried way too much about inflation because of the influence of some of the bigger countries that have had a history of very high inflation. Right now, I don't think that's the big concern that Europe should have. And so the ECB should maybe switch from being so concerned about price stability and worrying a little bit more about keeping inflation on track over the medium to long run. If you have higher inflation for a little while after a really big recession, maybe that's not the end of the world. Maybe that's okay. As long as you're not letting prices get out of control, it's okay to have a little bit of inflation. So that, I think, would be the biggest change that I would like to see to the ECB.
We do have some more time, so if anyone has any more questions, please do drop them in the box at the bottom. We do have some more time to go through them if you have any.
So I just want to say that we talk about all this stuff in the module, right? The module covers all of this, all the issues around the Eurozone crisis, the financial crisis, how monetary policy and all the different components work. Obviously, we don't have time to go into that detail today, but you know how QE works, what is the evidence for it. All of those things are covered in the module.
Okay, well, if we don't have any more questions, I'm trying to talk slowly just in case somebody is typing. Is there anything else you wanted to say before we wrap up, Pedro?
Yes, so I just wanted to briefly talk about so I'm going to share the screen again. I wanted to briefly talk about what teaching will be like next year. Hopefully you can see that. And so these are the plans that are in place. Sorry?
Yes, we can see it.
Oh, that's excellent. So these are the teaching and learning plans for 2021 by the Department of Economics. This is where people are thinking of doing. So currently, I obviously don't want to be overselling anything or telling you anything about how things are definitely going to be. That might not be the case. But these are the current plans. They're still being revised. And of course, the situation might change significantly in the next 4 months, and we might need to adapt them. But at the time being, this is what we're thinking of doing, and this is more or less what I think you could expect for the first term at least. And the idea is that the large lectures, because they are much more of a problem in terms of the possibility of transmission, because they require a lot of people in the same closed space, those are going to be online. So all of the large lectures, and I think most of the lectures are planned to be fully online, but the seminars and labs and any events where you have a smaller number of people those are scheduled to take place in person. Now, I appreciate that many of you would be commuting for some amount of time, that you don't live very close to campus. There are talks ongoing to ensure that the disruption of that is minimized. So to whatever extent is possible, making the seminars happen on the same day, for example, so that people don't have to come to campus for 1 hour in a day and then nothing else, and then another day for another hour. That kind of thing is something that is being discussed at the minute. But the idea is very much that the larger lectures will be online, the seminars, labs, and all the things that are more, so they're smaller groups and are more interactive, that these are going to be, or at least that's the plan, that they should happen on campus and in person. We're going to be making use of all of the software that we've been using throughout this last year or so. So Zoom is going to become, or keep going as an important tool. Other tools like Microsoft Teams, Moodle, lots of different technology around quizzes, online polls, virtual labs, all that sort of thing. Those are things that are currently being used and were deployed last year and will continue to happen. So hopefully it will be as a minimal disruption as possible, but things might change. So I don't want you to go away from this thinking that this is set in stone. It's very much not, but these are the current plans for the next year. Okay.
Brilliant, thank you. We haven't had any more questions come in. So I think we will call it there. But thank you to everyone here who joined us this evening. And thank you to Pedro for your time as well. If you do have any more questions, is there a way that they can get in touch with you, Pedro?
Yes, they can just send an email and I'll do my best to get in touch back with them as soon as possible. So if they have any queries, they can email either the department or myself. I'm sure then emails will be made available somewhere.
Yeah,
so if that's possible.
The follow-up stuff, that's not a problem.
Yeah,
and if you have any questions about teaching and learning or anything like that, I would really recommend getting in touch with our admissions team and they will be able to help you. But once again, thank you so much for joining us. Thank you, Pedro, and have a lovely evening, everyone. Bye.
Thanks.